positive in order to try to address some of the vulnerabilities. Think about residential real estate. So, this is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you very much for coming here.
I would just like to add something, because we are here standing in Amsterdam, and my colleague Klaus Nord is with us. And for those of you interested, we had just a fantastic meeting that was organized under the auspices of the De Nederlandisch Bank, under the leadership of Klaus, and it's been just a really good, fruitful and productive experience. Geography matters, and hospitality can help a great deal. So thank you to the Netherlands, and thank you to the National Central Bank of the Netherlands.
And our next scheduled press conference is on 21st of July in Frankfurt.
Hospitality in Amsterdam is not helping out this bond market. From New York City this morning, good morning, good morning. Let's talk about this price action. We're set up as follows for the euro on euro dollar, following a decision from the ECB to keep rates unchanged, but tears up for a move in July and maybe a bigger one in September. Euro dollar just a break of 107 at 106.89. Here's the move in the bond market. This is where things get interesting. In Germany, a 2-year yield higher by about 10 basis points. On a 10-year, just a little bit lower, higher by 6 basis points to 141. That curve flattening. This curve isn't. In Italy, what a breakout on an Italian yield curve, up by 16 basis points on a 2-year, up by almost 20 on a 10-year to 355. Let's call it 356, pushing 360. So in July, we're set up for 25 basis points. What about September? The ECB president leaving the door open to a 50 basis point move.
The answer is yes. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Let's head over to Amsterdam and catch up with Bloomberg's Maria Tadeo. Maria, run me through your takeaway of the last hour.
Look, Jonathan, I think in many ways she just confirmed what we got from the statement, that this is the end of an era for the European Central Bank. Of course, we're heading into a 25 basis point hike in July, and there will be now another one in September. That was on paper, and she repeated that verbally. They're, of course, opening potentially the door for a 50 basis point. She did not push back against that, but I think for me, the real takeaway, and if you're listening to the number of questions, there was this idea of fragmentation. She got 4 questions of fragmentation. She repeated, we can't afford that. We're going to deal with that. We've done it in the past. We've done it in the future. But however, there was a lack of detail that I think when you look at the market reaction, especially BTPs, the spread, also the way it's moving on the German one, it was underwhelming. And the fact that she kept repeating the same answer without actual details of it, I think that was very, very underwhelming. And you're coming out of a conference where a lot of investors right now, especially if you trade the BTP, it's not obvious which way the central bank is going to go, but also how ready they are to provide this buffer, and in particular, what shape and form.
Which is why we're seeing some big moves in this bond market. Maria, great work as always. Maria Tadeo in Amsterdam with the European Central Bank on tour this time around. You heard the opening bell ring there about 40 seconds in. We're down 0.4% on the S&P. On the Nasdaq, we're down by 0.5%. No real drama here. But over in Europe, this move in Italy, in Germany, it gets your attention. It got the attention also of Mohamed Al-Arian, who tweeted the following: the more I listen to ECB President Lagarde's remarks, the more I feel that this Governing Council meeting will be remembered as marking the official recognition of a consequential secular change in both the economic outlook and the policy regime. We get lucky this morning. Mohamed joins us right now. Mohamed, let's start there. Your takeaway from the last couple of hours.
You know, it started by being a somewhat more hawkish outcome, and then the more I listened to President Lagarde, the more I realized that she was signaling this consequential change in the policy regime. This is a big deal, what went on in Europe, and I think the market reaction is indicative that the market is starting to understand that we've exited one regime and we've entered another regime. You know, if you listen to her carefully, she almost said that 50 basis points would have been the right move today if it weren't for the history of not having moved for a long time. That is quite a statement And it opens the door, not just a little, wide open for 50 in September.
Some people will struggle with this, Mohammed, this idea that they can be gradual when inflation has an 8 handle and rates are still negative 50 basis points. And they'll only be going 25 basis points in July. So what we face, Mohammed, is Europe going through a whole summer of high inflation with interest rates still negative. Now, Mohammed, I get it. It's a big change for someone that's followed the ECB for a long time. I get all that. But when you look at where policy is relative to where the data is right now, that's a long summer, isn't it?
It is a long summer, but John, you also rightly showed and tweeted about Italian spreads. And that is what's holding them back. They really are worried about fragmentation. So they're going to have to strike that very delicate balance. As I said, I think that they would have rather go 50 than 25 in July, and they may still do it. I wouldn't rule it out completely, but yes, they are late. Yes, they've got to get going, and she stressed it's a journey. She kept on talking about the journey that they're starting to embark on. So she's trying to give a very clear message that if you net present value what they intend to do, it's equivalent to moving quite a bit early on.
Should we talk about this journey together? For July, 25 basis points. For September, in the statement, this is what it said. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Then they went further, Mohammed. I was surprised by this. I thought they'd tee us up for July, give us something for September, but then to say we'd see gradual and sustained hikes after that. We're now thinking about not just interest rate hikes for the first time since 2011, not just exiting negative rates for the first time since 2014. Mohammed, we're thinking about a rate hike cycle at the ECB. You and I have spent months talking about what is achievable for the Federal Reserve. Given the breakdown that we're seeing in the Italian bond market, which is recovering just a little bit on my screen at the moment, how achievable is a rate hiking cycle at the ECB, and what does it actually look like from your standpoint?
So I think it is achievable. I think it's achievable if only their own forecast is 6.8% inflation for this year. Their own forecast is 3% for next year. So they've got to move. I do think they have the tools to counter fragmentation pressure. What the market is nervous about is they didn't hear details, but they have set up mechanisms to counter fragmentation. The worry, John, is unlike the Fed, the ECB has only one objective, and that's inflation. And the real economy is going to suffer. Look, I'm willing to bet you, John, that when we get the next set of revisions, growth will come down even more than what they've brought it down. And remember, we are in mid-year. I'm amazed to see how big the revisions are for the current year, given that they're happening in June. Look what the OECD did and the World Bank did earlier this week. There's a major downward revision of growth going on around the world.
I want to speak to those revisions right now, Mohammed. As you speak, we've got them on the screen. 2.8% is the GDP forecast for this year. It's down from 3.7. The inflation forecast now 6.8. The previous was 5.1. I had a guest earlier when I asked them, Mohammed, is it achievable to get 2.8% growth in Europe this year? And they said no, recession. You've said the same thing before. These central bankers don't forecast recessions, Mohammed. They certainly don't do that if they're forecasting higher interest rates either. What do you think those revisions will look like on the growth side, coupled with the pressure on the inflation side?
So I suspect we will get a lot lower than the current 2.8% this year, with a few countries of the Eurozone in recession. Why don't they project it now? There's enormous institutional inertia. I worked in a multilateral for a long time, and I can tell you it's very hard to make major revisions unless you're in the midst of a crisis. So we should expect the next round of revisions, and that's true not just for the ECB and the Fed, but also for the OECD, also for the World Bank, to include further downwards revisions in growth and further upward revisions in inflation.
What do you think takes priority? The inflation side of the story or the growth side of the story? When they meet again in September and the revisions evolve in the way you expect them to?
Inflation for the ECB. That is their objective. That's what they're going to be judged on. They are way behind, and they've got to move. So inflation, and the tone of President Lagarde was completely different from anything I've heard from her before. This is quite a significant change in tone.
She was asked 1 million times about fragmentation, Mohammed. I wrote down some of the stuff she said. Within our mandate, we are committed to preventing fragmentation risk in the euro area, and the why, it would undermine the ability of the ECB to achieve its price stability mandate. Now, from my vantage point, others too, Mohammed, some people might sit here and say, are they contradictory goals to try and avoid fragmentation risk and also to tighten financial conditions sufficiently to bring inflation down? The ECB is saying they're not. What do you think?
I think they're not. And the phrase that you should have written down, John, and I'm sure you did, is monetary transmission. She linked the two by monetary transmission, that if you get fragmentation, you will not get the proper transmission of monetary policy. And that is correct. As I said earlier, John, I think they have the tools to counter fragmentation. So the fear of fragmentation is not going to get in the way of this journey of higher rates.
We're going to spend some time talking about the Fed in the next segment, Mohammed, but I wanted to tee it up with you, just as the ECB as a reference point. How different is it with this ECB joining the Federal Reserve in this tightening cycle in a way that it just did not play in the last 10 years? This feels so different to me. The ECB sat it out last time around. It's not this time around. The BOJ sat it out last time around. They're trying to do it again. That's an interesting element in all of this as well. But Mohammed, just your thoughts on that at the moment.
Oh, it is very different. I mean, in fact, you could argue that the ECB has leapfrogged the Fed. President Lagarde spoke about how they looked under every stone to figure out why the inflation forecasts were wrong. The Fed hasn't done that yet. The Fed hasn't explained to the marketplace why its forecasts were so wrong. She then talked about a journey going beyond September. The Fed hasn't been as explicit. Their guidance is really till September. So in a funny sort of way, not only has the ECB joined the Fed, they've leapfrogged the Fed. And you saw that initial reaction in the FX market as the marketplace recognized that this was a significantly more hawkish ECB than the statement suggested. I mean, the press conference will be looked back, I think, as a seminal event.
Just watching this Italian 10-year story fade just a little bit more. We were positive more than 20 basis points on a session, now up just 15. Mohammed, I want to keep building on this with you. The ECB is playing in a rate hiking cycle in the way that it didn't with the Federal Reserve. You think this is becoming the more important story slightly, perhaps? The BOJ's not. This has consequences for foreign exchange. We're seeing this push up against dollar yen. Dollar yen through 134 overnight, seemingly at one point pushing 135. It could have consequences for the bond market in a way that we didn't see in the last cycle either. Mohammed, I've been surprised by how quickly some people have got comfortable with the idea that we might have seen a peak on a 10-year yield in early May at 320. Comparing it to what we experienced maybe in late 2018, this time around, German yields aren't sub-zero, they're positive. As you sit and look at bonds at the moment, Mohammed, how big a change is that, and how does it influence your thinking on where this bond market is going?
So I think we're having a general tightening of financial conditions around the world, and I think that's important. Yes, Japan is the outlier, but look at the functioning of the Japanese government bond market. It is not functioning well. It's clear that it is reaching the natural limits to unconventional policy. So even Japan is going to have to somehow exit from the regime that they're in. So this is a consequential change in the bond market. It's clear for what happens to the front end of curves. Once you get to 10-year or beyond, you have to worry about the growth implications. And that's why you've had this incredible volatility that we've seen in the 10-year in the US because of the different growth outlooks that have played out. John, I would keep a really close eye on the functioning of these bond markets because, as you know, there's three sorts of risks that the market are having to navigate. One is interest rate risk. They've navigated that rather well, not perfectly, but rather well. The second one is credit risk. They're embarking on this now. And the third one, which is the ugliest of all, and we don't want to have to navigate it, is liquidity risk.
Well, Mohammed, I'm not sure there's even a market in the JGB market in Japan at the moment, as we both witnessed this week. Another trading day. Haven't seen that this year, I don't think, so far. Another trading day of no trades whatsoever on a 10-year JGB. Mohammed, we're lucky. We're going to get another segment in with you, and we're going to talk about inflation, which is due tomorrow. Looking at this equity market at the moment on the S&P, we're down 0.5% with some movers. Just quickly, here's Abby.
John, a bit of wild action here on that ECB decision because, of course, ahead of it, the U.S. 10-year yield had been lower. At that point, tech higher. Then it shot up 4 basis points, bringing tech lower. And even though the 10-year yield is now flat, we still have big tech reverse lower. Apple down 0.8%. KeyBank also seeing signs of softening of demand in U.S. NVIDIA, they signed a partnership with Hynix. That stock is lower, however. One outlier, Tesla, up 1.2% on some positive trends in China. And then speaking of China, Alibaba cooling off after a 28% 3-day move. Today down 4.4%, maybe because of the yield story and also the idea that there could be limited lockdowns in Shanghai this weekend. Alibaba right now down 4.4%, similar to U.S. tech right now, tech.
Abby, thank you. Coming up, inflation, top of mind.
Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
Except it's not, because core inflation is also running at 6%. Tomorrow, we're looking for another big print. We'll have that conversation next.
We're the strongest economy, and that's allowed us at least to stay on top of and a little bit ahead of what's happening around the world. Look, Inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
The latest read on inflation in America, 24 hours away. The administration and investors bracing for another elevated print. With more, here's Katie Lyons.
To be 8.2% on the headline for the month of May, John. And of course, even if that is a slight moderation from the prior month, when you look at the month-on-month figures, it's expected to be a higher number, about 0.7%. So prices are still climbing and wages are not keeping pace. And that's really the problem for the Biden administration, because the American consumer is feeling the pain, especially as for the last 2 months straight, the primary consumer expenses, fuel, power, and grocery store food have all been rising at double-digit annual rates for the first time since 1981. Food prices up nearly 12% in May. That's going to be one big contributor to the headline number. Another is the spike in gasoline prices. Pump prices up 8.2% last month, still climbing, now near $5 a gallon. They have more than doubled over the course of the Biden administration so far. But of course, neither gas nor food goes into that core metric. When you back those out, the print is expected to be softer, 0.5% month-on-month, 5.9% year-on-year, as you see demand moving out of goods, consumer discretionary goods, and into services. But our economists here at Bloomberg Economics, John, say that speaks to the mistake the Fed made. What started as supply-side goods-driven inflation has now widened out to services, which is stickier, and that means 50 basis points is going to be the move for maybe longer than this market expects, John.
Kelly Lyons, thank you. Still looking for a headline number with an 8 handle potentially. Month-over-month core is what this market will look at. Wall Street will be focused on, and even there, 0.5% is the estimate so far. That's elevated. We're lucky. I've said that 3 times now. 3 times a chime. Mohammed, thank you, sir, for being with us still. Let's go there. What are you looking for from CPI in the United States tomorrow?
So I have no reason to have a different forecast from the consensus of 0.5 and 0.7 month on month. But what worries me, John, and you're not going to like this because it's looking forward, the June month on month print will be worse than the May month on month print. I think those who boldly said inflation has peaked and it's coming down may have to change their minds. I wouldn't surprise me if we see a headline print that's much higher than the 8.5.
Next month. Mohammed, why?
Not as early as next month, because first, the drivers of inflation are broadening, and that's due to the Fed policy mistake. Secondly, at the headline level, energy prices are going up month on month quite dramatically. And thirdly, we're seeing pressure on shelter and food. So if you look at all the components, it's way too early, unfortunately, to say that inflation has peaked. I hope it has, but it would not surprise me if we go above 8.5% on a yearly basis.
Hey, Mohammed, this is really important. I remember when you gave me the call early last year, and you said, I don't think this is transitory. This is important. I'm pushing back. And you went out there in force, and that force got more powerful as the year progressed. I get the feeling this year, Mohammed, that we still haven't totally relinquished this idea that a lot of this is temporary. I hear from a lot of guests who think that we've seen the peak, a mechanical peak year over year, and for good reason, and they think the Fed backs away in September. Are you stressing this is going to persist through the whole of this year, that we're not going to get that drop-off that so many people are hoping for, looking for?
John, if we get a drop-off, we'll get it for the wrong reason. We'll get it because of demand destruction, and that would be tragic. The last thing we need is for inflation to completely undermine the demand side, because then we have not only a price issue, but we have an income issue. And once again, it will be the most vulnerable segment of the population that get hit the hardest. So in a way, be careful what you wish for. So if you believe the labor market stays strong, wages remain buoyant and start catching up to inflation, then it's very hard to see inflation coming down. If, however, you think that we're going to have a recession, sure, inflation is going to come down, but that's not the sort of transitory inflation that anybody wants.
Can you take any confidence from the labour market prints we've had recently, Mohammed, that we've seen robust jobs growth, yet we haven't seen unemployment come lower, we haven't seen wages accelerate? Can you take any confidence? Is there any sign whatsoever that we are slowly getting the supply side response that can alleviate some of this pressure?
Yeah, I certainly do. To be clear, recession is not my baseline. You've heard me say over and over again, it's stagflation is my baseline and recession is my risk scenario. John, the only thing I wish for on the labor market side is higher labor force participation and higher wages, believe it or not. That's the only thing that's missing. Otherwise, this labor market is very strong.
So when we wake up in September, we've had 3 more inflation prints going through the summer, and they sit down at the end of September at the Federal Reserve. Jackson Hole's behind us, all of that, Mohammed. What do you think the Fed has to confront, and how do you expect them to confront it?
I suspect first they'll be happy that most of the blame will have gone to the administration, unfairly so. You know, when I look at the mistakes made or the drivers of inflation, the administration comes 5th. However, it is the administration that's going to be blamed. So I think there'll be some relief in the Fed that people won't quite understand how much of this is a Fed policy mistake. But second, they're going to have to be much clearer about that path. And you've heard me say this, much clearer about what mistake are they willing to underwrite. Because right now, they are so late, John, that there is no first best policy response. That was last year when you and I were discussing it. Now, it's about minimizing the mistake. And they're going to have to make a choice and stick to it. The worst thing is the flip-flopping Fed. A Fed that hikes rates and then pauses in September, then starts hiking again and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Mohammed, you were right, they were wrong. And we're lucky for a 4th time to catch up with you, sir. Thank you very much for being with us. Mohammed Al-Erian from Queen's College, Cambridge there, breaking down the latest move from the ECB, looking ahead to CPI tomorrow and looking ahead through this summer, the challenge that the Federal Reserve faces, a challenge in the minds of Mohammed and others of their own creation in some ways. Coming up, the market moving events you need to be watching. Your trading diary is up next. 25 minutes into the session, equities doing okay. Unchanged, treading water if you will, going into CPI tomorrow at the ECB. Unchanged on the S&P 500, positive just a little bit on the Nasdaq by 1/10%. Following the ECB, rather, some of this price action settling down. CPI tomorrow is your trading diary. President Biden delivering remarks at the summit of the Americas at 2 p.m. Eastern. Then tomorrow morning it's the main event, US CPI coming on Friday, followed by the University of Michigan Consumer Sentiment Survey. Looking ahead to next week with US PPI on Tuesday, a Fed rate rate decision and Chairman Powell news conference next Wednesday. Then it's the Bank of England's turn with its own rate decision on Thursday. And finally, it's the Bank of Japan's turn next Friday. So a ton of really important central bank decisions coming next week. Before we get there, US CPI. And this country facing another headline print with an 8 handle. This market focused on the core month-over-month read, and even that is looking elevated. From New York, this is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, June 9th. Here are the top market stories that we're following for you at this hour. Lagarde, we will deliver. The ECB president says the central bank will make sure inflation returns to its 2% target and leaves the door open to a 50 basis point hike in September. Spreads blow out. Equities sell off. Bond yields spike higher. Off the highs of the session, though, the Italian-German bond spread blows out to the highest in 2 years. It is the aftermath of the ECB. And Freeport LNG fire lights up natural gas. The company shuts down an export terminal in Texas, adding more stress to a tight global LNG market. We're going to speak to Francisco Blanch, Bank of America Securities Head of Global Commodities and Derivatives Research. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. You know, Guy, Christine Lagarde must be very happy that this press conference was over. She really didn't go with the whatever it takes, stayed with gradual, but really tried to say, we're going to deliver, guys. Don't worry, we're going to deliver.
Yeah, there's a lot of vagueness, a lot of uncertainty around exactly what comes next. I was listening to Mohamed El-Erian talking just a moment ago, talking about the idea that this was a paradigm shift. I don't think we quite know yet the details of what the new paradigm is going to look like. Clearly, fragmentation is a concern. Lots of questions on that during the press conference. But the ECB economists are really struggling to get a handle on this, aren't they? Growth downgrades, inflation upgrades. It's a bit of a 1-2 punch that we're getting here, Alex, isn't it? We're getting Christine Lagarde today, and we get US CPI tomorrow. I think Friday afternoon, it's going to be an interesting point of reflection.
Spoiler, it's going to be hot. Inflation will be hot. Let's get more into the ECB here. The bank committing to a quarter-point increase in interest rates next month, also leaving the door open to a bigger hike in the autumn. Here's Christine Lagarde at today's press conference.
We expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Let's get more now from our Europe correspondent Maria Tadeo, who's in Amsterdam for that meeting. Maria, okay, September looks like a done deal. Do we have an idea, though, if it's going to be 25 or 50?
Yeah, and Alex, a lot of this press conference, she repeated essentially what has been very well guided, calibrated. You know, we put the asset purchase program to an end, and then of course you hike in July. It's 25 basis points, so that's pre-committed, that's in there. But again, to me, what was interesting is the way you go forward. She did say and repeated the European Central Bank is on a journey, that this is not step-by-step measures, but this all form a path. Now, when she was asked about September, you know, to me, she didn't really push back against the narrative that 50 basis points could in fact happen. And I think essentially that's going to be the narrative from the next 3 months. Particularly, we see inflation the way it is right now, with prints that at times triple, quadruple the objective from the European Central Bank. So that's for the inflation rate. I think the other important thing to come out of this press conference, perhaps not as clear, however, was how does the European Central Bank deal with the market volatility that will come with the rate hikes. Now, you're seeing already that reaction in the bond market, particularly in the BTP moves that we are seeing over the past hour. To me, it's ironic nonetheless. This marks the end of an era, perhaps the Mario Draghi era coming to an end, but we're back again talking about BTPs with Mario Draghi now in office.
Okay, let's talk about that fragmentation risk, Maria. Do we have any idea about the tools that are on offer, really, to deal with that fragmentation risk? I was listening again to Mohamed El-Erian. He thinks they've got it. He thinks they do have the tools to be able to deal with this. But this is so critical. If fragmentation occurs, and we've all lived through what fragmentation looks like, if that occurs again, transmission doesn't work. Does the ECB really have the tools here to be able to tackle this if it was to emerge once again?
Well, and she repeated that the European Central Bank, of course, will want to avoid that. She said, we've done it in the past, we will do it in the future, and we can adjust tools. If they have specific one, they clearly did not reveal that, and it was underwhelming for a lot of investors. I think they really wanted to find out, not just in the abstract, but like clear hints in terms of the shape and the form that this tool would take, also the pain threshold potentially that the European Central Bank would take. And I think, to me, the fact that she was asked 4 times, I counted, what about fragmentation? What about fragmentation? But did not go into detail, almost magnified this idea that the ECB, if they have a tool, they don't want to reveal it, so perhaps that's jittery for the market. And if they don't talk about it because they don't have yet, or they don't have consensus around it, well, that's more of a problem. That's more problematic, definitely, in the short term.
Yeah, that was really the game-changing moment for the markets, where yields really pushed higher, where the euro wound up rolling over, etc. There were also some questions basically on credibility. I mean, if I parse through the language, many reporters said, why should we believe you? Did she give a good enough answer to beef up ECB's credibility?
Well, look, she repeated, right now, European Central Bank is committed, of course, to bringing back inflation to target. The European Central Bank would do the job. She also conceded at this point it's not a desirable level. She said that a number of times. But when it comes to the forecast, which persistently, of course, have been off the mark, today we got new projections both for growth and GDP. Again, you see big revisions happening there. She did say the mistakes are coming due to unpredictable factors that are not easy to model. So again, referred to the war in Ukraine, seen the impact that it has on Europe. And at times it's worth reminding ourselves that the impact that this has on the European economy is much bigger than it has on the UK, and is much bigger than it would have in the United States. She also said there's elements of energy. It is difficult to predict the way forward when you have errors around the pricing of such things. So overall, yes, she's trying to defend the credibility of the bank, but I guess as always, when it comes to central banks, it's about the data.
Is going to be about the numbers, isn't it? And there's a lot still to go. Are we going to get significant further revisions, both on the upside for inflation and the downside for growth? Great work today, Maria. Looks lovely in Amsterdam. Thank you very much indeed for joining us. Bloomberg's Maria Tadeo. Coming up, we're going to get market reaction to the ECB. Bridgewater's Karen Tambor is going to be joining us. That conversation is next. This is Bloomberg.
Great questions.
Started by being a somewhat more hawkish outcome, and then the more I listened to President Lagarde, the more I realized that she was signaling this consequential change in the policy regime. This is a big deal, what went on in Europe, and I think the market reaction is indicative that the market is starting to understand that we've exited one regime and we've entered another regime.
That was Bloomberg opinion columnist Mohamed El-Erian earlier on Bloomberg Television. Welcome to Bloomberg Daybreak America. Nope, that's the wrong show. Welcome to Bloomberg Markets. Wow.
Wow.
That happens when you're stepping from brain fog and fatigue.
Alex has woken up about 4 years ago.
Yep, I was out for 4 months and I woke up 4 years ago. Okay, we're in Bloomberg Markets. Now let's get to the question of the day. Can central banks actually get inflation to 2%? Karen Tambor, co-CIO of Sustainability at Bridgewater Associates, she joins us now, and she's one of Bridgewater's foremost experts on macroeconomics and FX markets. Karen, the way Mohamed El-Erian was talking about it, this was a seminal moment. This is a huge game changer for the ECB and then for central banks. And I'm wondering if you believe that we can actually get to 2% inflation.
Hi, great to be here. I don't think with the amount of tightening that is currently priced in, we can get to 2% inflation. And so markets are starting to process the tightening is going to be necessary. Europe is finally getting, the same type of market action that we got in the United States as the Fed was tightening, which is all assets are falling. Bonds and stocks fall at the same time. You don't get any diversification across the two of them because inflation and the need to tighten is the driver. And when that happens, you are trying to slow what is a very strong economy to cool inflation. But if you look at actually the amount of tightening that is currently expected, it's still not that significant relative to the strength in economies, relative to the self-sustaining momentum in inflation. So will it slow the economy? Yes. But will it be sufficient to get central banks back to their goal? No.
Karen, isn't this the compromise we're going to have to live with, though? Nobody wants a recession. Nobody wants a significant slowdown that probably would be required to get inflation back to target. So we accept inflation in the 3 to 4% range, but we don't get the aggressive recession that would come with 2%. Isn't that the compromise we're now dealing with?
I think you're exactly right, Guy. This is why it's really not easy to be in the shoes of policymakers right now. They're going to have to choose whether to make that trade-off, and it's really not an easy trade-off to make because you don't want to let inflation get out of control, and at the same time, it is painful to have the economy slow because of tightening. And it's especially painful if you're Europe, and part of the reason you're getting inflation are things like energy and food prices that you don't produce. And so it's this inflation that's particularly painful, and you have to slow your economy if you literally just can't get enough energy to power it. And so we know from the 70s that central banks faced in that situation really prefer not to over tighten because it's painful. And the more it's external, the more it's geopolitical, the more you're not the producer making money from the inflation, the more painful it is. But we also know from the 70s that they can be behind for many, many years and it can get out of control. I think reasonable policymakers are going to disagree about what to do here, but the risk is that they fall behind and they're so scared to crack the economy, which is right now at such strong levels that they just go too slow.
So, Karen, when you take a look at what happened to spreads, we talked about this a bit earlier with Maria, that the game-changing moment really happened when she's like, we don't have a plan for spreads yet, but we're going to work on it, kind of thing. Is there any plan that they can do to help tampen down spreads that would, in essence, then help support the economy in different countries while also being able to tackle that 2% inflation?
I believe there's a tremendous amount the ECB can do. They've already shown us time and time again that if they think this is important, there is a lot they can do to handle periphery spreads. The main thing when I look at the market action is, look what's happened to credit spreads globally. It makes sense for all risky assets to be selling off into this environment. This is just a tougher environment. And so I'm not sure if I were the ECB that I'd be jumping ahead and making lots of plans for spreads just because the market moves so far. I'm sure they have many plans in their back pocket and they can control it if it gets out of control.
I read Greg's piece in the FT talking about how you guys are positioning around all of this. Karen, in the kind of environment of 3 to 4% inflation and slower growth, how do you navigate it? Just kind of walk me through what you think the building blocks of a portfolio in that kind of environment look like.
Well, the challenging thing in that environment is that most of their risk is in beta and being long assets and holding assets and hoping to make a risk premium. And most risky assets, frankly, look terrible in the near term. So yes, over time, you believe that holding bonds, holding stocks, holding credit spreads, you will make a risk premium. But in an environment of rising inflation and a need to tighten into that, you get terrible performance sort of across the board. And so one consideration is how much can you move towards more tactical positioning, alpha, actually make money off of shorts. And the other big consideration, if you have to hold assets, is how much inflation protection can you get? If you're holding stocks and bonds and you've gotten used to the idea that they're really diversifying, that's because growth was the dominant issue, and every time growth fell, bonds could do well, and vice versa. And today that's not the case. And so inflation protection is really what most investors are missing, and adding that in at least helps the circumstances. But this is just a bad environment for risky assets, and that's the reality for most investors.
Where might a central bank put be? I feel like we know it's not in the equity market. Is it in the bond market? Is it going to be in the private market? I'm trying to get a sense of where the biggest financial risk is that the Fed and the ECB are going to have to then respond to.
I think if you're the Fed and the ECB, you would not be that worried today about a peak in financial assets. Financial assets have outperformed the real economy for a decade plus. That's been engineered, that's how it's been working, that's been the desire. And now I think it's completely within their desires to have financial assets underperform the real economy to a material extent. And you're seeing that, for example, as tech has cracked, as crypto has cracked, there's been an understanding that this is not that significant. This is not a significant risk for the Fed yet. They need to slow the economy to a degree, and it's healthy for it to start in areas where there were bubbles of overvaluation and pockets where a lot of money went when a lot of money was printed. And so it's pretty healthy for financial assets to do very poorly relative to the real economy for some time now in this environment. It's painful for investors, though, because we've just lived with a decade plus where constantly financial assets did significantly better than the economy. So an investor could do great even as the economy was kind of mediocre at times.
Okay, so let's just come back to what I want to own at this point. You talk about the underrepresentation of inflation-based products in most people's portfolios. Commodity funds have come up a long way already, Karen. Are they going to go further? Linkers have done relatively well. TIPS have done relatively well. Are they going to continue to outperform? When I look at the inflation options that I have, what still looks like good value within that basket?
You're right, it's not great because what's happening in commodities is you do have inflation protection, but you also have significant idiosyncratic risk in every commodity that you hold, especially oil. You know, small changes in geopolitics can make a big difference. And obviously growth matters a lot. And so, for example, in any commodity that's not oil, China is a huge part of the demand, and you can only imagine how much Chinese demand has slowed because of the zero COVID policy. And so commodities don't look nearly as well as they did when you just looked at generally high nominal growth, high real growth and high inflation. Once you kind of have high inflation but weakening real growth, commodities don't look as attractive as they did a few months ago. And while it still holds some, not nearly as good as it was a few months ago. And then same with linkers. I think you're in a situation where if you have to hold bonds, I would completely pick linkers over a nominal bond if I had that choice. If I had to hold a bond, I'd rather just get paid whatever CPI is and just receive it. And, you know, if it comes up above expectations, it's not expected to be that high. I mean, you asked at the beginning, how likely is that inflation goes back to 2? Linkers are basically pricing that they'll go back to, you know, something like 2, 2.5. So I want to get paid anything they are above that. If I have to hold a bond, I'd rather change it to a linker rather than hold a regular bond.
Karen, to that point, we got a question from a viewer, and this kind of ties into what Guy was just asking. What are your thoughts on emerging markets? If you have developed markets, central banks are really in kind of a bind. What about the higher yielding EMs?
I really like some of the stock markets, especially because you're in this situation where just so much outperformance has been priced into the United States. And so you're already expecting that U.S. companies will keep taking market share from everyone for another decade to come. It's pretty hard to do that decade after decade after decade, and it means it's already in the pricing. Whereas a lot of the pricing in the emerging markets is frankly pretty terrible. And the other piece is that we just lived through this period where people had so much money, right? Consumers all got literally checks to their homes. So you saw a lot of money being printed going into many assets, and it actually didn't go into emerging markets. Typically, those are really popular risky assets when you have these boom periods. And instead it went, you know, to crypto, to tech. So emerging markets are not nearly as vulnerable as they typically are in this part of the cycle where money's starting to come out. Now, that doesn't mean they're not vulnerable at all, but as I said, they're not great options today. Some of the emerging market equity markets certainly look more attractive to me than being in the US, which is already priced to perfection.
Just in terms of what you do want to be in right now, you talked about being short. What do I want to be short of, Karen?
Well, I still do not like nominal bonds very much. And increasingly, I don't like U.S. stocks very much because if you basically look at how much U.S. stocks have fallen, and you say a stock is just a series of cash flows discounted back to today. Yep. You can attribute the entire decline in stocks just to higher bond yields, just a higher discount rate back to today. Actually, almost nothing has been priced in terms of a slowing in the economy. Actually, fewer cash flows rather than just a higher discount rate. Almost none of that's been priced. And if you look at the Fed raising rates at the rate that it is, and now the ECB raising rates, if you look at how much asset prices have fallen, it does not look very likely to me that you're not going to get a slowdown in the cash flows that companies are getting. In addition to that, you go back to the 70s, and you had a very significant rise in risk premiums. Investors didn't want to hold stocks because you were in a situation that was just trickier to manage the economy because inflation was so volatile. That could happen today too. So I think the decline in stocks can confuse people, and it might be hard to not see with the naked eye that all that's happened is slightly higher rates. A lot more can get priced into U.S. stocks in terms of an actually weaker economic outcome and and volatile inflation.
Which is kind of what you were talking about before, that like we could engineer an economy that's okay, a softish landing in the economy and then a hard landing within the markets. Just before you go, and this goes back to that FT piece also, what part of corporate credit is more vulnerable if cash flows are vulnerable and yields are rising?
Well, I think if you're looking at individual companies, you have to basically ask, what is the chance that they can flow through the inflation that's coming back to their customers? And so probably the best case study of this is you look back at the 1970s, and there's huge differences between companies, whether they were actually able to flow back to their customers what that inflation was, or they had to take it and basically had terrible profit margins as a result. Now, in the 1970s, 30% of the U.S. stock market was resources. So we had a lot of companies, and same in the corporate credit markets, that they could benefit from inflation and clearly pass it on. Today, there are a lot fewer companies like that. Resource companies are, 3% of the stock market or something. And so you're in a situation where you really have to be looking at, people like retailers have a much harder time. So you want to look at basically how likely do you think the company is, either from an equity or a debt perspective, to be able to handle that higher inflation environment.
What do you think default rates go to in that kind of environment, Karen?
I don't know if I can call a number, but really, I think a lot of the pricing will not necessarily be about defaults. Like a lot of the corporate debt that people own is companies that are not close to default, and you are dealing with how much risk premium you're putting on the volatility of inflation and how likely they are to be able to manage through that situation, not on sort of actual default rates. There's of course a tail that will actually default, but right now a lot of the pricing is basically a shift in the environment, saying it's going to be a harder environment to navigate rather than true default probabilities coming up.
Hey, Karen, thanks a lot. We really appreciate it. We think you're great. We love talking to you. Karen Colonel-Tambor of Bridgewater, thank you very much for your time. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Target has raised its quarterly dividend by 20%. The new payout implies a yield of about 2.8%. That is a full percentage point above Walmart's yield. The move comes after Target lowered its profit outlook for the second time in less than a month. Tesla staged a remarkable comeback in terms of its production over in China. The electric vehicle maker tripled its output in May from the month before, producing more than 33,000 cars. That is despite only only recently getting its Shanghai factory back up to speed after the city's lockdowns. And Bloomberg's learned that a consortium of Apollo Global Management and Reliance Industries has made a binding offer for the international unit of Walgreens Boots Alliance. The proposal puts a value of about $6.3 billion on the business, which runs more than 2,200 Boots drugstores across the UK. A rival group, Britain's Isa Brothers and TDR Capital, has considered dropping out. And that is your latest business flash. Guy.
Rebecca, thank you very much indeed. Another UK company being bought up. There seems to be plenty of that around. Alex, I keep thinking about what we've got going on in here in Europe and Christine Lagarde, and I keep putting it together with the story we got in the natural gas market. We don't know where the energy story is going in Europe. Every time we get the results of the latest staff projection from the ECB, they're way off where they were before. I don't know, as a central bank, how you make policy in such a volatile environment and make accurate predictions as to where economies are going, where a fire in the United States in an Energica plant can completely knock you off course.
Well, and I think the problem is that in theory, those things should be transitory because they're gas, food, etc. But if we're also dealing with a structural shift away from Russian energy and also away from fossil fuels in general, that's not structural. That's going to be a multi-year cyclical process. That's a structural multi-year process. And I think that is a serious problem that may be underestimated, that you can't fix by any amount of hikes that you do.
I know, and that's the problem. Some of this stuff is out of the control of these central banks. Anyway, we're going to talk energy next. Francisco Blanch is going to be joining us from Bank of America. This is Bloomberg.
About that all day yesterday.
right, we're just about an hour into the U.S. trading session. Stocks trading a little bit heavy, but now we're waiting for that CPI number in the U.S. tomorrow. Bloomberg's Abigail Doolittle is tracking some of those moves. Abigail?
Alex, it really is all about that CPI number because this is a week-to-date chart, and you can see it's going to come down right to the wire. We've had big up moves, a down move, up moves, down moves. Right now, we're slightly higher in the week, but a moment ago, we were slightly lower. So again, it's going to be a really right down to the wire relative to that CPI print and where is inflation. Now, of course, we have reports right now of massive food inflation. We're seeing something for the first time that we've seen since 1981. That is double-digit increases for both food and for energy. And here's back to October of 2021. Food up just 3.2%. We'll take a look at this now in May, up nearly 12%. It's just incredible how much we have seen food absolutely rising. We're also seeing something unusual relative to the 210. Now, it is narrowing, or tightening, I should say, in sharply over the last year or so. But the 2-year right now at its highest level, I think at 281 the last time I looked, the highest level since 2018, that 10-year yield at 303. So it's going to be interesting to see whether or not we tighten more and maybe go back toward the inversion we saw in early April. As for some of the top stocks on the day, let's take a look at what we have going on here. And NXP Semiconductors up 8.2% on speculation from a blog that there could be some M&A action there, a possible buyout. Tesla up 5.5% on news that its output in China in the month of May tripled despite the lockdowns. We also have an upgrade from UBS to an outperform. And then finally, rounding it out, Costco up 2.4%, a piece of that inflationary story, Alex.
All right, thanks so much, Abigail. And to that point, U.S. natural gas stockpiles actually rose 97 billion cubic feet last week. That was actually a bit more than the week before. So we're getting a little bit of stockpile that's probably only going to get worse now that you have an LNG export terminal shut down for a couple weeks. So part of this energy story that Guy and I were just talking about, it's so bad now that President Biden went on Jimmy Kimmel last night and talked about many things, but in particular, the gas crisis.
Inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump. Oil companies, instead of everybody says, well, Biden won't let them drill, they have 9,000 drilling sites that they've already owned that are there. They're not doing it. You know why? Because they make more money not drilling and buying back their own stock.
You know when a president goes on a late-night talk show, like, it's getting serious. That approval rating is pretty grim. Let's get more insight now on what happens to commodities. Francisco Blanch, she's Global Head of Commodities Derivatives Research over at Bank of America. Great to see you in person. Nice to see you.
Good to see you, Alex. Great to be here.
So help us. You've had 120 target on Brent for a while. What's going to be the top here?
Well, I think the first thing I would say is that the crisis in the oil market hasn't arrived yet. And I don't say that lightly because I think we've been in a massive global gas and power crisis for the last 18 months or so, with prices of natural gas in Europe being close to $500 per barrel of oil equivalent, right? And we've also seen recently, because of all the disruptions created with Russia, thermal coal prices rising to $100 a barrel of oil equivalent. So when essentially sand or dirt on a barge is trading at $100 a barrel, you look at oil at 120, doesn't seem that expensive. So I think we are not at the peak yet. The pressure is going to continue. But the one thing I'll say is that despite all the pain that we're seeing at the pump in this country, the U.S. is so much better off than everybody else. Because remember, we have record dollar values, meaning we have an incredibly strong dollar with strong commodity prices, which means the pain at the pump in Europe and Asia and everywhere else is way, way worse. So that's a big issue. So I think we're going to get some demand destruction. We're getting some demand destruction.
Yep.
But again, prices have to do a lot of work because we don't have the supply, Alex.
You used the word crisis just a moment ago. We're not there yet. What does the crisis look like in your mind then?
Well, we think, depending on how the sanctions go in Europe, we could see the European sanctions on Russian energy. We could see maybe $150 a barrel, maybe a little higher. But I don't think this is going to be a 3-month issue, a 6-month issue. we need to fix the supply side, and it's a very, very hard thing to do. It's not just about returns. Remember, the energy sector has had terrible returns for the last few years. We've had 3 bear markets in energy in 16, 18, and 20. So it's not just about buying back stock. The history is pretty bad for energy investors.
Sorry, so you don't think this is, when you say it's not a 3-month or a 6-month problem, is the implication there that it is a more than 3 or 6 month problem?
Yes, I mean, I think we're moving into probably a multi-year issue if the Russia-Ukraine situation doesn't solve itself out and we start to see flows from Russia normalizing over the course of the next 12, 18 months. And really, the big challenge here is that to fix the supply side, we also need to provide industry with some guidance as to how we're going to accomplish the energy transition. Because we did stop investing in thermal fuels, partly because of the poor returns, but also because we were supposed to be driving electric vehicles by the end of the year. And at the same time, we kind of forgot to invest in metals. Right?
And that's in essence, I think, you can blame an oil company for buybacks or whatever, but why are they going to invest in something that everyone wants to phase out? That's a really hard thing to kind of wrap your mind around. So does that mean that that we could see a spike to 150, or is this a sustainable spike to 150? Because even if we get a resolution of the Russian invasion of Ukraine, I mean, I can't imagine all of a sudden Europe's going to go great and go buy at market value Russian oil anymore.
Well, I mean, that's a great point. We definitely need to up our investment in the energy sector. And one of the challenges, again, I mentioned $500 a barrel gas in Europe, but before $500 a barrel gas, we had a spike to $350, and before that, we had a spike to $250. And what that's done to European demand for gas is it's knocked it down 3 times over the course of the last 9 months. So I guess what I'm trying to tell you, and another way to think about this, is we were looking for 3.5 million barrels a day of oil demand growth globally this year. In 2022, we're looking to get back to $100 a barrel. 100 million barrels a day. The challenge is we don't have the supply. So therefore, we can only grow our demand by 2 million barrels a day as opposed to 3.5. So to slow down the rate of demand growth, we just need a higher price. Now you're saying, okay, Francisco, so we have no inventories. We have this tons of money in the economy and people want to spend, buy. We don't have the supply. Therefore, in order to bring demand down, we just need a higher price. And that's exactly what's going on. You can call it stagflation. I call it we have no supply, we have no inventories. And therefore, prices have to do the work for us. That's it.
Can we just talk a little bit about the actual mechanics of getting molecules around the world? Europe desperately is in need of gas from around the world, not Russia in the scenario you're painting. How, at the limits, is the current supply chain for gas? We've just seen a big fire. It's had a significant impact in terms of pricing. Are we trying to squeeze every single molecule we possibly can through liquefaction plants right now? And if so, how volatile could the environment be? How easy is it going to be to knock that supply chain story off course?
Well, Guy, I mean, I'll just say, summer of 2020, European TTF gas was $1. March 2022, European TTF was $80 per MMBTU. We've gone from 1 to 80. I mean, can we get more volatile than that? I mean, it almost feels like a cryptocurrency at this point.
Yeah.
It's an incredibly volatile environment because we have a very messed up supply system. We need to expand not just LNG export capacity, we also need to expand storage infrastructure in the US, in Europe, and Asia. More pipeline capacity. I mean, just to put it into context, the amount of gas that Europe buys from Russia equates the amount of gas that China and Japan buy from the global LNG markets every year. Now, do we have the ability to create 2 Qatars overnight to essentially cut Russian gas from the European supply system? It's going to be a pretty hard thing to do. So, look, I'm not kind of giving you a lot of good answers here, but I think prices are. And to your point, the volatility of the commodity markets is going to stay incredible because, again, all I'm saying here is we're going to see more inflation, more volatility, more basis risks. And again, basis risks mean risk to the term structure of commodity markets, risks to the different prices across different regions, the prices of different commodities, corn versus wheat, gasoline versus oil. All of that's going to be very volatile.
Well, I'm glad you brought that up because this is, so MLive is doing a big commodity theme this week, and the question they have is what's going to be the best performing commodity in the back half of the year and then the worst. And it's hard to pick, right? Because there's so many that have so many supply issues.
Right. That is right, and I think the big issue here is going to be, I think, how do you address? I think on the energy side, look, coal prices are so expensive, and we are, I think, eventually going to get some response on the coal side, potentially. Although we've had an election in Australia that may tilt the supply of the world's second largest exporter. So maybe we can get some relief there. U.S. natural gas, if we have a warm winter, could end up being the worst performing commodity. Because remember, even though we're $8-9 per MMBTU, warm weather into the winter will bring U.S. natural gas down to $3 an MMBTU. So that could be one, I think, on the energy side where we get a lot of relief. But again, we need the weather. And I'm telling you, we are right now, you asked Guy this question, are we on the edge? Yes, we're on the edge. I mean, energy supplies are limited. Growth is still very robust. And China is in lockdown. I think the best performing commodities of the year, if China comes out of lockdown, could be commodities, could be jet fuel, could be some of the metals that have been depressed because China was scaling back demand. So that's how I think about it. And then, of course, there is the food issue, which that one is a lot more difficult to forecast because of what Russia is doing to the Ukrainian agricultural sectors. So I don't think the issues are going to go away. And I even think a recession will not be a fix. I think we'll see some recessions in different parts of the world, but I don't think it's going to be the fix that we're hoping for because there's no much substitution across the complex and because everything is so tight. So even if demand comes down a little bit, that's not necessarily going to resolve the multi-year problem that we have ahead of us here.
Francisco, great to catch up. Great to see you in the studio. Thank you very much indeed. Alex always laughs at me and tells me kind of that I'm an Englishman watching the weather. I think we should all watch the weather. I think it's going to be really important.
You talk about it all the time. I mean, that's the thing.
That's what we do. But it's important, as you just heard. I've just been backed up by Francisco. Francisco Blanch of Bank of America, thank you very much indeed. Coming up, Wall Street's top regulator is setting up for a fight over stock market rules with some of the biggest names in equity trading. We're going to talk about that story next. Joe Moglia, Fundamental Global Investors Chairman and former CEO of TD Ameritrade, joining us next. This is Bloomberg.
greatest minds.
SEC Chair Gary Gensler proposing a set of sweeping changes aimed at making the U.S. equity market more transparent and fair for retail investors. Let's break that down for Bloomberg's Sonali Basak. We have payment for order flow versus an auction process. Walk me through what we have now and what could change.
Yeah, so right now it's exactly what it sounds like. Market makers will pay a brokerage for order flow. The idea here being that they share some of the profits made from the spreads when it comes to trading. That's what keeps retail trading prices zero in many cases. Robinhood, though, makes about 80% of its revenue just from processes tied to just this in equities and options markets. So that's paying for order flow. The worry for Chair Gensler here is that he's worried that it may not be the best things in all cases for retail trading clients. So what is he considering? He's considering an auction process, which is exactly what that sounds like, auctioning for the best execution here and auctioning for those trades. Remember, there's a third option here, which is internalization, and it's when brokerages handle their own order flow as well. The challenge here, guys, is going to be incentives.
Sonali, you talk to a lot of people. Is the consensus that payment for order flow is probably on its way out here?
Something that's interesting about this guy is the data. Market makers are really asking for more data behind what is really best. When it comes to payment for order flow, we have some data in terms of what is being paid from the brokerages, or it's from the market makers to the brokerages, but what is getting the retail investor the best price? Bloomberg Intelligence's Larry Tabb has done some work on this already, and he's found that when you're paying for order flow, retail investors are capturing 47% of the spread. What does that mean? That's 39% for market makers and 13% for brokerages. So you are seeing the retail investor get the most of that price improvement. Can the SEC show which model is best in a data-driven way? We haven't seen a full analysis of what that could look like yet.
I think that would be really interesting and maybe answer the question that we're trying to figure out here. Sonali, thank you very much indeed. Bloomberg Sonali Basak. Let's carry on the conversation. Joe Moglia, Fundamental Global Investors and Capital Wealth Advisors Chair. He's the former CEO, of course, of TD Ameritrade. Joe, does the system need changing? Do you think Gary Gensler is on the right track here, or are we good as we are?
No, we actually had a conversation about this when the whole meme thing and GameStop and Robinhood and Melvin Capital and Citadel crises was going on. And one of the things that I said then is that the regulator's job, the SEC's job, to come in and find out, was there wrongdoing? Did somebody really didn't take advantage of the system? And if they did, and if they did something wrong in order to take advantage of, they're supposed to be held accountable. I think always when you do something like that, is there something that they can improve? But all of that doesn't have anything to do specifically with payment for order flow. Robinhood, when they had to stop trading, that doesn't have anything to do with payment for order flow. The Citadel issue doesn't have anything to do with payment for order flow. And the Citadel hedge fund, the Melvin Capital thing, that wasn't an issue with payment for order flow. I think Sonali did a very good job of kind of walking through what some of the options are. I think it might make sense to walk through this from an investor's eye. Does that make sense?
Yeah. Hey, Joe, okay, you know what? Joe, we're having a little bit of problem with your audio. If there's a way we can maybe tweak it. It's really hard to hear what you're saying. While we focus on that, Joe, let's go back to Sonali for a moment. Sonali, what part of the system is actually broken that we do need to fix? That's what I'm kind of struggling with.
Well, what's interesting is people don't understand there is a lot of disclosure around payment for order flow. This happens at least quarterly where you see exactly how much every market maker is paying every brokerage. But what you don't get as much clarity into is the retail investor getting the best deal at the end of the day?
So what problem are we trying to solve here?
It's what the retail investor gets. What happened after the GameStop saga, I think a lot of retail investors didn't even know that their order flow was being paid for, that was the business model, right?
But Sonali, I want to come back to what you were saying just a moment ago. We need to see the data that tells us that the consumer is getting a bad deal here. Until we see that data, are we certain that the consumer is getting a bad deal and that things need fixing?
Yeah, I think one really interesting question is internalization and the difference in the models. If the SEC